Okay, good morning, everyone. Welcome to the section today. Today is Saturday, the 13th of March, 2021. And today, our discussion will be on looking at some salient things we've discussed earlier on with respect to other principles in business combination. And we're going to look at this principle before we more or less look at group adjustments. Okay, and these are what we wanted to consider today, and in order to wrap up significantly. To start today's program, we'll look at other principles in business combination, and those two principles we are going to look at, one borders on issues that relates to the differences in accounting policies, and also we'll look at recognition of contingent liabilities in a business combination. Okay, remember that we had a discussion some time ago on the fact that the parent and subsidiary are expected to have the same accounting policy before consolidation can take place. And equally, they are expected to have the same reporting date for consolidation to take place. But the reality of the fact is that it is not a must that they must be, but rather, if they are not of the same policy, before consolidation can take place, you must realign the accounting policy of the subsidiary to that of the parent before consolidation can take place. Likewise, we also discuss of the reporting date. Once they are not far apart of 3 months, you can go ahead to consolidate subject to material adjustment that might impact those 3 months. But anything that warranted to be more than 3 months with respect to differences in the reporting date will require a reconstruction of the account of the subsidiary to align with the reporting period of the parent before consolidation can take place. And that is what we discussed earlier. Now, to demonstrate one of them, which is the uniform accounting policies, we're going to look at this illustration as a pivot to giving us understanding. Okay, in that light, I will call on Marian. Can you read this illustration for us? Or let me extract the illustration first and take it to our whiteboard. Just give me a minute. Okay, you can proceed now.
The following illustration will assist in establishing the principle as required by the standard as it relates to the adjustments on uniform accounting policies within the group. Illustration 1, you are given the statement of financial position of Pali and its subsidiary SUSI as December 31st, 2015. Statement of financial position as at 31st December 2015. Additional information. A, Pali acquired 40 million of the 1 Naira shares of SUSI on 1st January 2014 for 50 million, when the reserves of the subsidiary showed a balance of 10 million Naira. There has been no impairment of goodwill on consolidation since acquisition. The market price of the company's shares prior to acquisition is 1 Naira 10 kobo per share. B, SUSI has all its accounting policies to be the same with that of Pali, except for that of intangible assets included in its books. A component of intangible assets of SUSI is is of a type whose recognition would not be permitted under IAS 38 intangible assets. IAS 38 is to be allowed in preparing the consolidated financial statements. When Pali made its investments in SUSI on 1st January 2014, the intangible assets of SUSI included 8 million naira that would not qualify for recognition under IAS 38. The intangible assets of SUSI are of indefinite life. Assume SUSI operates under different accounting standards, which are similar in all respects to IFRS, except for some aspects relating to recognition of intangible assets.
Okay, who can explain what the principle or what the question is trying to examine? The floor is open. Who can explain? No return?
Good morning, everybody.
Good morning, sir.
Okay. My understanding of this illustration is that it tries to test the difference in accounting dates with respect to the parents and the subsidiary. However, the question lets us understand that the accounting dates for parents and subsidiary were the same, except for only one component, which is the component of intangible assets, as recognized by IAS 38. That is the only one I believe we need to adjust for before the consolidation can take place.
Okay, I think what you are referring to is accounting policy, not dates.
Oh, sorry, accounting policy, yes.
Okay, okay. In most of the situations, the accounting policy of the parent and the subsidiary are the same, except for the policy towards recognition of intangible assets. Okay, and in that regard, what do? It's for us to realign the policy of the subsidiary to that of the parents before consolidation can take place. Okay, therefore, what can we do at this point? Is for us to first of all put up our structure. What is our structure? Pali? SUSI? NCI? What is the stake of Pali in SUSI? I think we're not given, but we're told that the number of shares held by Pali in SUSI is 40 million. But the question is, how many shares are in SUSI? SUSI share capital is 50 million, and the price is 1 naira, which means the number of shares in SUSI will be 50 million naira divided by 1 naira per share, will give us what? 50 million shares. Therefore, it means out of the 50 million shares, Pali acquired 40. For my calculator here, $40 divided by 50 percentages is 80%. Therefore, I can come here and say 80%, and this is what? 20%. When was the date of acquisition? And when are we reporting? The acquisition took place 1st of January 2014. and we are reporting on 31st of December 2015. How many period apart is this? Can anyone answer? How many period apart?
2 years.
Yeah?
2 years. 2 years.
2 years. Okay. Now let's split the reserve. That's Susie. Let's split it into 2. All figure in millions. The reserve as at reporting date is 20. That's 20 million. And we have to split it into pre-acquisition, which is as at the date of acquisition, and post-acquisition profit or loss. What is our pre-acquisition? The reserve stood at 50 million when, okay, sorry, we acquire 40 million shares for 50 million naira. Okay, when the reserve of the subsidiary showed a balance of 10 million, therefore our pre-acquisition is 10 million. What then is our post? If pre-acquisition is positive 10, what is post? Who can answer that?
Positive 10.
Positive 10.
Is our balancing what? Figure.
Yeah.
Positive what? 10. Okay. Now, let's go back to the question. We are told that since Susie has all of his accounting policies to be the same with that of what? Pali, except for intangible assets included in his book. A component of intangible assets of Susie is of a type whose recognition will not be permitted by IAS 38. Now, if IAS 38 will not permit such recognition as an intangible asset, probably because the subsidiary is not using IFRS in full, probably it's from another jurisdiction that does not make IFRS compulsory. But the only problem we have with his account is that his recognition of intangible is not totally in tandem with IAS 38. I remember you can't consolidate a subsidiary that its account is not IFRS compliant. You must realign it. Or because you are preparing group accounts in accordance with IFRS. Therefore, what then happens is that such that does not qualify as an intangible asset will have to be derecognized. But something was said here, that IAS 38 is to be allowed in preparing the consolidated financial statements. When Pali made this investment in Susie on 1st of January 2014, the intangible asset of Susie included 8 million that would not qualify for recognition. And the intangible assets of Susie are of indefinite life. Who can interpret these two statements? Let's start with included 8 million that does not qualify. And the second one is that the intangible assets of Susie are of indefinite life. Who can explain this? Shegun, I think your mic is on mute.
Okay. Yeah, from my understanding, 8 million that will not qualify under IAS 38 simply means that probably there are other intangible assets that qualifies, I don't know, but there's a particular set of assets that is worth 8 million naira that doesn't qualify for recognition under IAS 38, especially because of the fact that the entity uses indefinite life for their intangible asset. That means that it's already something like land that does not depreciate, and intangible assets must be subjected to amortization according to the principle of IFRS. So in this case, for the subsidiaries account to align, for the subsidiaries policy to align with that of the parent, we have to readjust that of the subsidiary to the parent by possibly using the policy of the parents with the expected useful life of the parent's intangible assets to also measure that of the subsidiary. So that is just what I can say about it.
Okay, who else? Who else? Babajide? Babajide, are you there? We can't hear you. Can you unmute?
Okay. For me, in addition to what Shegun said, from the question, we could see that there is 15 million intangible assets for Suzy, meaning that 7 million is, sorry, I'm trying to look for the question. My screen
The
is,
question is on the screen.
yeah, my listing is, okay. Sorry, a minute. Where's my view? Where is this thing? Okay, let me just, from what I've seen before, it's not showing on my screen now. I think I just, my settings of my laptop. Okay, it shows that from the intangible asset of Suzy, from the question is 15 million, showing that 8 million, there is 7 million that are, what's the term used now? Sorry, I can't see the question.
Just explain, you don't need to call the figure.
Okay, so now I want to use the term used. Where is this thing?
That they do not qualify.
Okay, yes. Which means that 7 million are qualified as intangible and 8 is not qualified as intangible. So for indefinite life means that for amortization purpose, the amortization period can be extended beyond the number of years that was given for amortization.
Okay, thank you. Now let me put it in this perspective. Now, if you look at the screen, the PPE, sorry, the intangible assets is 15 million. It's 15 million. Now, and this is as at reporting date, which is 2 years after acquisition. In our mind, this will have been the carrying amount after amortization. Okay? But there's a phrase here that says the intangible asset of Suzy are of indefinite life. Asset of indefinite life means asset to which there's no reasonable basis to estimate the useful life, which is served as a basis of amortization or depreciation. Therefore, such an asset with indefinite life, such as goodwill, such as land, are not depreciated. Which means this 15,000 or 15 million is the same amount as at the date of acquisition. As at the date of what? Acquisition, because we have been given a clue that this is not item that is depreciable nor subject to amortization. Now, that is what this phrase is meant to do. But the most important of it all is that, one, they said a component of intangible asset of SUSI. A component means it is not all of the intangible asset of SUSI. Do you get it now? If it's not all, what it simply means is that the component is of the type that its recognition would not be permitted under IAS 38. Therefore, what that signifies is that, okay, the component that will not be permitted, we have to derecognize it as at acquisition. Now, if we have to derecognize it, let us look for that component. That's why the phrase came here to say, the intangible asset of SUSI included 8 million that will not qualify, which means 8 million is a component that will not what? Qualify. Therefore, what do we do? First, we have established that there was no amortization or depreciation, which we'll have also adjusted for, but our only adjustment is to derecognize as at acquisition a component of this 15 million. And what component of it? The component is this 8 million. Now, how do we do that? We come here. Derecognition of a component of intangible assets of SUSI as at the date of what? Acquisition, in line with the requirement of IAS 38. Now, if you are to recognize an asset, you credit the asset account, which means intangible assets, SUSI. And you what? You debit. It's like expensing it, which affect profit or loss, and which will have been closed out to the retained what? Earnings of SUSI. How much is that in Naira? 8 million. Doing so means that by the time you deduct 8 million from 15, what is left is what? 7 million. That is what Gide was trying to explain the other time. Now, if that is the case, how does this affect our goodwill? Goodwill. Now, I think the question gave us option to which we have market price, Abi, which means we can use the two options and let us see the result of the two. A and B, all figures in millions. Cost of business combination. Palace investments in SUSI, and SUSI has NCI, A, and what? And B. Now, what is A? We'll come back to that. What is investment here? The investment here is 50 million. Which is the same thing here. This 50 million is the same thing as this 50 million here. Now, I'll Hello, I said if this 50 million, let me put highlight. If this 50 million here is different from this 50 million here, what will have been the cost? Babajide, we can't hear you.
I said 40 million.
I didn't get you. What do you mean by 40 million?
You said if this the cost of investment in SUSI.
If this investment in SUSI 50 million is different from this 50 million, what will have been the cost?
We were told that Pali acquired 40 million of shares of the one naira shares of SUSI on 1st of January. It should have been 40 million naira.
No, that's not the question.
Okay.
Do you buy shares at nominal value? The 1 naira is just to tell you there is a nominal value, which is this 1 naira, this 1 naira. That has nothing to do with how much you buy company. No? Okay. I'm saying that this 50 million, you know, they told us here the investment in SUSI PLC is 50 million. Yeah, they told us also that is 50 million. But what if they're not the same? What will have happened?
Okay, it should have been 50 divided by 40.
No, you're not getting the question.
Okay.
Okay, Shagun, I think you want to say something.
Okay, I was trying to look at it that if the investments as at the date of acquisition is different from what is being carried by the parents as of the dates of consolidation, that's if they were not the same, it could have been because of some assets that were derecognized as a date of acquisition.
Okay, let me explain. If this 50, let's say what is here, let's say it is 45 million. And this is 50 million. One of those things that can account for it is one. Probably the parent has not recognized all of his investment in the subsidiary, which means probably he has a deferred payment, which is a deferred consideration or contingent consideration that he failed to recognize because he doesn't have understanding of IFRS 3 that says even when you have not paid, but you pay at a later date, such should be recognized as part of the cost of consideration. That is one. Two, it might be that the accounting policy of the parent, which we have done before, is to carry it at fair value instead of at cost, in line with IAS 27, separate financial statement, which means he has fair valued it and probably there's a fair value loss on it. Or this might even be 52, which means there's a fair value gain on it. But if I want to make it worse, is that let them just say investments. Let us say they cancel this. There's nothing like investment in Suzy. What you saw is investments. And when you see investment, it is not 45, we saw something like 52. But what we have here is 50. What do you believe is the difference between 52 and 50 when this only carries investments? Not that it carries specifically investment in subsidiary. Who can explain the difference between this 52 and 50?
So maybe in that case,
investment.
we can say there are other investments apart from Suzy.
You have said it all. Other what? Investments. Other investments cannot account for the two in it. The essence of emphasizing this is for us to have basic understanding of the principle, so that you don't get to see situations that might slightly be different and you just believe that, no, something's wrong. No. Every word in financial reporting counts. That's why it is principle-based and it is structured after the conceptual framework, which are all principle-based. Okay, let's go back to the question. Now, what do we do? The investment is 50. We have no problem about it. We only digress to have better understanding in case of the future. Now, we don't know what our X is. We don't know what our Y is, but we'll proceed. Now, fair value of Suzy's net assets as at the date of what? Acquisition. Share capital and pre-acquisition reserves. Now, share capital is how much? Is 50, and pre-acquisition reserve is 10. Come here, 50, and what? And 10. Why am I putting my 10 beside? Who can tell me why am I setting my 10 aside? Who can tell me why I'm setting my 10 aside? I'm setting my 10 aside because there is a component of it that is affected as a result of the recognition. Remember, our retained earnings has been overstated because we failed to have expensed 8 million naira, being a component we recognize as intangible asset rather than an expense, naturally. Because when you say something does not qualify as an asset, what does it qualify as? It's an expense. Is that not? From the element of the financial statement. Therefore, we less the recognized intangible assets. Let me write it clearly. How much? 8. What is left is what? 2. And this gives us what? 52. Please. Now, if that is 52, we have 20% stake of 52 million. 20% of 52, that is 10.4. And this, we are told the market price is 1 naira 10 kobo. Okay. And remember, if the entire shares is 50 million shares, and Pali only acquire what? 40 million shares, which we did there. It means the remaining 10 million shares belong to non-controlling what? Interest, which means 1 naira 10 kobo times 50 million shares minus 40 million shares is the 10 million shares that belong to NCI. At 1 naira 10 kobo. 1 naira 10 kobo times 10 million shares, give me 11. All things being equal, I have 60.4 and 61. Therefore, what is my goodwill? My goodwill as acquired is 60.4 minus 52. That's 8.4. And 61 minus 52. That is 9. But there's an information here. The information says that there has been no impairments on goodwill, Abi, which means there's no impairment on goodwill. Therefore, our goodwill value has not changed from what it is as at the date of what? Acquisition. I remember this is a partial goodwill. And this is what? A full what? Goodwill. Now, any question on the goodwill? The area that we emphasize in this question is on this. Any question?
I have a question.
Yeah, what's it?
Okay, now they told us that 8 million naira of the intangible assets does not qualify according to IES 38. But we know that this is an asset that generates economic benefits. And even after acquisition of the subsidiary, the parent will still continue to enjoy economic benefits from these assets. Why should we now derecognize and expense it instead of now aligning it with the policy of the parents? For instance, begin to charge amortization on that asset based on the useful economic life of similar assets of the parents. Why do we have to derecognize instead of still carrying it as an asset and then charging amortization on it? So that is my question.
Okay.
Sorry, in addition to, sorry,
Also,
sir,
okay.
so that you can answer the question together. In addition to what Shegun said, what if parent has a similar asset and in the parent book before acquisition of subsidiary, parent recognize such an asset in its own book by giving it a specific use as a useful life based on the policy of the parents?
Okay.
Also, sir, in addition, I'm trying to understand when you said the asset that we are recognizing will be expensed in the book. Is that a matter of principle, or is there another way of the recognition?
Okay, let me start from the last question. Whenever you recognize, okay, let me start like this. When you say you buy something, there are two questions you ask. Whenever you incur a cost, you ask two questions. Is it an expense or is it an asset? The reason why you are saying is that if it's an expense, you charge all of it now, and you write it off against your revenue or income, whatever you have. But if it's an asset, say no. Capitalize it, which means just warehouse it somewhere and be removing the portion that belongs to each year and charge it to your income in each year. The question then is, what you thought that is for 2, 3, 4 years before that you capitalize as an asset, you now discover that no, it does not really qualify as what? An asset. Therefore, what do? You go back to what is supposed to have done before if you have had the benefit of hindsight to say, no, it doesn't qualify, which means you should have expensed, not capitalizing. Which then means, what do? When you are not told that this thing you put as asset is no longer an asset, you have to recognize. What are they saying? Is that, no, this no longer need to be spread over future years. It is to be expensed all in all now. Does that address that? Okay. The next question, which is Nuruddin, was with respect to amortization. Am I clear? I can't hear you.
Yes. Yes,
okay.
You are clear.
Now, you said we should amortize it.
I said if parent has similar intangible assets.
Now,
and
the question is, if the parent has similar intangible assets, the same treatment accorded the parent is what we are called the subsidiary for the purpose of aligning the accounting policy. But not necessarily would they have the same basis of amortization or depreciation. Because even within the same company, the same class of assets might not have the same depreciation rate, because within that, let me say you have motor vehicle. One is for executive car, one is for a staff bus. Can you tell me that they have the same depreciation rate? The answer is no. Because when we get to IAS 16, you discover that depreciation is not a policy. Depreciation is a basis of making estimates. Which then means that depreciation should reflect the pattern of your consumption of an item. Anything you consume more faster will have accelerated depreciation. Anything you consume in bid that will take longer time to finish its consumption or its usage will have a longer useful life. Are you getting it now? Which means if they belong, the parent and subsidiary have similar assets, the policy will be the same, but not necessarily the basis of estimation. Does that answer your question?
Yes.
Now, let me now come back to Shegun. Shegun made a claim, which I want him to substantiate. He said this asset that we are recognizing has future economic benefit. I don't know where he got that from. Because the question said it has intangible assets, and a component of it does not meet the requirement of IAS 38, which means it doesn't have any future economic what? Benefit. That's what it means. Therefore, but he said, how can you recognize something that you still enjoy its benefit? And I'm asking, where does such information arises to say this asset we are talking about to has future economic benefit? Because the information before me is so explicit to say the asset we are talking about. See what they said here. Susie asks all these accounting policies to be the same with that of Pali, except for that of intangible assets included in its books. A component of intangible asset of Susie is of a type whose recognition would not be permitted. Anything not permitted by IAS 38 is so clear. Do you get that? It's so clear that it is not going to have a future economic benefit. And that rests that case. Do you get me?
So yes, sir,
Okay, sir.
I
Excuse me,
understand.
sir. You know, if you read the last sentence that says the intangible assets of Susie are of indefinite life,
Yes.
which also include this asset that we are derecognizing.
Yeah, because there are two categories of intangible assets in SUSI. Those that are permitted and those that are not permitted. Now, those that are permitted as indefinite life, that is why the one that were not permitted that we thought it qualified equally has indefinite useful life. And the essence of stating that is that if it is not an indefinite life, our adjustment will not stop here because there's going to have been an amortization from 2014 to date, which means we have to also reverse the amortization related to such transaction. But in this case, there was no adjustment for amortization because an indefinite life asset would not have been amortized.
Okay, understood.
Okay. Now let's look at NCI. NCI as at acquisition date (10.4 and 11). Share of post acquisition profit, that's 20% of 10 million. That's 2. No impairment, nothing. Therefore, this will be 12.4 and 13. Consolidated retained earnings, Palace Reserve, what is Palace retained earnings? 50. Share of post acquisition profit, 80% of 10 million. That is 8. Okay, let me go up to copy a balance sheet. Okay. Okay. Is Pali as at 31st December 2015, I have A and B. PPE. What's our PPE? 40 and 35. That's 75. Intangible assets. Have goodwill and have others. Remember, I told you about others. Why we need to disclose them separately. Can you remember? Who can remember what we discussed then? Who can remember? Now, what is goodwill? Goodwill is 8.4 and 9. Others, what are others? Others are original goodwill in the books, which is 10 and 15. $10 and $15. But remember, we made an adjustment to recognize 8. Who can remember the 8?
Yeah.
This 8, can you remember this 8?
Yes.
Yeah. Therefore, once you take that away, that is 17. That should give us 75 plus 8.4 plus 17 will give me 100.4. 75 plus 9 plus 17 will give me 101. Okay. Current assets. I have 20 and 40. That's 60. All things being what? Equal. 160.4, 161. Share capital. Ali. What's share capital? 60. And what is consolidated in earnings? 58, 58. Therefore, I come here and say 60, 58. 60, 58. That gives me 118. NCI, 12.4 and 13. 12.4 and 13. That gives me 130.4, 131. Current liabilities. Current liabilities, your payable, 10 and 20. That's 30. Any question on this? Any question on that? Any question? Any question? Okay. Now, I'll give you this assessment, and we'll have a few minutes to look at it. Let me cut it off. I'll give you 10 minutes to look at it, and we'll collectively attempt solving it. You have 10 minutes to look at it one by one, and we're going to discuss it with respect to other principles. Okay, you can start now.
So,
Okay.
illustration 2. Given the statements of financial position of Pali and its subsidiary Suzy as 31st December 2015 are as follows. Additional information. 1. Pali acquired 40 million equity shares of Suzy on December 31st, 2015. 2. The market price of the company's shares prior to acquisition is £1.50 per share. 3. There was a liability that is contingent upon unfavorable legal disputes to the right to intellectual property, which is estimated reliably to cause the subsidiary award of damages of 5 million.
Okay. Now, what principle we want to test here border on contingent liability.
Contingent liability
is with respect to contingent liability at the point of acquisition. This is where the principle lies. Now, we'll go back here. And I want you to do something for me. Nuruddin, can you introduce us to contingent liability perspective with respect to IFRS 3? Proceed.
Okay. Contingent liabilities. Contingent liabilities usually give rise to material loss upon crystallization, which is expected to be incorporated in the financial statements of companies. Contingent liabilities of the acquiree for consolidation purpose are recognizing their fair value can be measured reliably. A contingent liability in this instance must be recognized even if the outflow of future economic benefit is not probable, provided there is a present obligation. There is, as opposed to the criteria of IAS 37, provision, contingent liabilities, and contingent assets. Contingent liabilities are not normally recognized, but only disclosed. After their initial recognition, the acquirer should measure contingent liabilities that are recognized separately at the higher of A, the amount that will be recognized in accordance with IAS 37, and B, the amount initially recognized. Invariably, it means that the recognition of the contingent liabilities upon acquisition will reduce the pre-acquisition reserves of the acquiree subsidiary. Recognition of contingent liability on acquisition. We debit reserves, retain earnings of subsidiary, then we credit contingent liabilities, accounts payables, with the contingent liability measured reliably. There exist instances where the subsidiary has adjustments to the subsidiary contingent liability subsequent to acquisition. The recognition of such only affects the post-acquisition reserves in the subsidiary upon consolidation.
Okay, read through this excerpt from IFRS 3.
Excerpts from IFRS 3 revised on contingent liabilities. Contingent liabilities, IAS 37, provision, contingent liabilities, and contingent assets defines a contingent liability as A possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. Or B, a present obligation that arises from past event but is not recognized because, scroll up. Because one, it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Or two, the amount of the obligation cannot be measured with sufficient reliability. The requirements in IAS 37 do not apply in determining which contingent liabilities to recognize as of the acquisition date. Instead, the acquirer shall recognize as of the acquisition date a contingent liability assumed in a business combination if it is a present obligation that arises from past events and its fair value can be measured reliably. Therefore, contrary to IAS 37, the acquirer recognizes a contingent liability assumed in a business combination at the acquisition date, even if it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation.
Thank you very much. What is the summary of this? The summary of it all is that if you refer to IAS 37 strictly, contingent liability should never be recognized. Rather, it should be disclosed. But there's an exception to that rule with respect to business combination, which is the requirement of IFRS 3 to say that whenever you have the contingent liability, one thing that is paramount in its recognition, as opposed to IAS 37, is that the obligation, the contingent liability must be present obligation. And once you can reliably measure it at fair value, even when it's not probable, it should be recognized in a business combination. And to demonstrate that understanding, that is why we need to look at this practice question. Now, to look at that, we go back to our board. Now, all other things remain the same, which we are known to, but what matters is, what do we do about this legal dispute that that more or less is a dispute over the right to intellectual property? And it can be reliably estimated that if awarded at fair value, the price will be 5 million. Therefore, what do? Let's go back first to draw up our structure. Group structure. What's the parent? Bali. And Susie. Date of acquisition, date of consolidation. When is acquisition? The two dates are the same. Okay. Is acquisition. Therefore, 31st/12/2015. Okay. What is our percentage holdings? You acquire how many shares? You acquire 40 million shares. Out of how many shares? Remember, this 50, this 1 naira. Therefore, that's number of shares in Suzy is 50 million naira divided by 1 naira. That is 50 million shares. Okay, what ratio is that? 40 to 50 million shares should give me 80%. And this is 20%. Now remember, Suzy's reserve as at today is entirely pre-acquisition reserves. Of how much? Of 20. Now let's try and determine our goodwill, if any. Do you have option to fair value? Yeah, we have the price, which means you can look at the two options, A and B. Cost of combination. Palace investments in Suzy and NCI, A and B. What is Palace investment in Suzy? That's 60 million. What is the fair value of the identifiable net worth assets as at the date of what? Acquisition, share capital. What's the share capital? 50. And what's pre-acquisition is up 20. I put 20 here because there's this phrase that says there's a contingent liability. And all of these are satisfied the requirement of IFRS 3 recognition. If that is the case, what do? We go ahead to recognize contingent liability. Therefore, I come here, recognition of contingent liability at acquisition date. And what creates liability is that increase in liability is as a result of an expense. Therefore, I debit my expense to the profits, which means to the subsidiaries reserves. And I credit liability, which is contingent liability. And this is in tandem with what No, didn't read the other time, which is, how much is it?
5.
5 million. Okay. Okay. This is in tandem with what you read. Let me show you again. This entry here. Okay. Go back. Therefore, I come and I say, let's recognition of contingent liability, which is the debit side of 5. And this gives us what? 15. Automatically, this gives 65. Now, 20% of 65. I think 20% of 65. That's 13. And second one says share price is £1.50.
Okay.
Times out of 50 million shares, 40 million went to the parent. That means 10 million to this. 10 million times 1.5. That's 15. That gives me 73 and 75. 75 minus 65. That is 10. And this is 8. Okay, that's our goodwill. As you all know, this is partial. This is what? Full. Now we can copy the balance sheet. Okay. Let me clean up. Okay. What's our PPE? 40 and 50. That's 90. Goodwill, 8 and 10. Okay, current assets, 20 and 40. That's it, plus 60. That's 158 and 160. Share capital pali, 60. Reserve, 50, because there's no consolidated here. 50. Is it 50 and 60? Okay, 60 and 50. 60 and 50. That's 110. NCI, 13 and 15. Payable, 10 and 20. Now, I'll put it to us. We have 153 and we have 155. Who can tell me what is wrong? The floor is open. Who can tell me what is wrong?
Yes, I can tell
What
you
is
that.
wrong is we've not added the contingent liability to the payable, which is
Thank
5
you.
million.
Thank you. Remember, we are past this entry. Yeah, we are past this first entry, but we are yet to pass the second entry. And the second entry means our payable will be affected by the 5, because we say we should increase our payable by how much? By 5. Our staircase. And which means what we have is not 30, what we have is what? 35. This gives us 158, and this gives us 160. Does it make sense now? Any question before we move further? Any question before we move further?
Sorry, I just want to confirm. What is the justification by IFRS 3 to say we should recognize this contingent liability when we are doing our business combination? Whereas when we are treating IAS 37, the provision said we should recognize only. Is there any justification for business combination to actually give us this reason to say we should recognize the contingent liability when the business, especially as at the acquisition?
Okay, thank you very much. Thank you very much. First, I share one document with you guys, okay, that talks about checklists for due diligence in acquisition, merger and acquisition, and other things. Yeah. And also last week or week before, we discussed on some contemporaneous issues in business combination. One of those critical ones is the indemnification asset. Okay. Now, what happened is this. What is a contingent liability? A contingent liability is a possible obligation or a present obligation that
arises from
likelihood of the outcome is not what is necessarily probable. Okay, if it's probable, it has crossed the line to what qualifies as provision. But because it's not probable, but it's possible or is present, that's why we consider it as a contingent liability. But remember, when a new person is coming to buy a company, it's not buying the assets, it's not buying the liabilities, it's taking over the assets and liabilities, plus any other things inherent in a business, because a business is seen to be continual, which means it is a continuous operation. Any liability of the past is binding on the new buyer of a business. Okay, and that's why you find out that whenever you are taking acquisition, there are other clauses you put in your contract agreement that says that any liability that are unforeseen that may crystallize on the business as a result of event that has happened in the past, which make it contingent, will be redeemed from the former owner of the business, because as at the time of buying the business, all what you have shown me was what was considered. There are some things that I might not know, but if it's a liability of the company, it is binding on me, regardless of whether I'm a new owner or not. Therefore, what the standard says is that if you are able to identify any possible obligation, especially those that are present, please bring them into books now, in order to know what is the true worth of what you are assuming. Are you getting what I'm saying now? Not something that tomorrow they start to crop up and you are unaware or you have not recognized it, and users of financial information would not have made correct decision on them. That's why the standard says once it is a present obligation, okay, only that is not probable, please go ahead and recognize it at the acquisition date fair value. But if you can't obtain the fair value, you disclose it. Or if it is not present, you disclose it. But once it is present, you understand, and it is present because there's a past event that has more or less created such an obligation, you should recognize it. Do you get what I'm saying now? Now, henceforth, subsequent to acquisition, what does the standard say? The standard says you now recognize it going forward at the higher of what has been recognized in line with IAS 37, looking at that principle strictly, or what you have recognized initially as at the point of acquisition, which is what you read here. Can you read this statement again here?
Okay, after their initial recognition, the acquirer should measure contingent liabilities that are recognized separately at the higher of A, the amount that will be recognized in accordance with IAS 37, and B, the amount initially recognized.
Now, in line with IAS 37, if it's still a contingent liability, you recognize that is zero amount. And if it's a provision, you recognize it as a likelihood which has been estimated as the amount of provision. You understand? Which means if it is still contingent liability, it will be zero. Okay. And the amount initially recognized is 5, which means you stick it at 5. But the day IAS 37 recognized as provision, and the provision is higher than 5, it means you recognize incremental amount from it. Does that make sense?
Yes.
And at any point in time, the liability no longer is required. For example, government court has now made a judgment that has discharged you of that obligation. What do? You write it back as income. Remember, liability is recognized when you have discharged it, you have settled it, or it has expired. Can you remember?
Yes.
And that is it. Any other question? Okay, we'll take a short break for about 5 minutes before we move to adjustment in group accounts. Adjustment in group accounts. Okay, now we'll be looking at adjustment in group accounts. And what this signifies is because of the need to create synergy, and most of the synergy are created as a result of involvement in the affairs of both businesses having common transactions in order to extract values, in order to minimize costs, maximize benefits, which more or less make the coming together of two companies in a group structure to give an equation that says 2 + 2 is 5, which means 2 + 2 is more than 4 because of the unspoken words or spoken benefit, which we call the synergy effect of such a combination or acquisition. Now, as a result of that, there are transactions that will be tantamount to double counting in the whole process of consolidation if such transactions are not identified and eliminated. And all what we'll discuss at this level is to identify those transactions and what do we need to do as regards those transactions. Now, common transactions that occur between the parent and the subsidiaries include sale of goods. Okay, one of those benefits you draw from a synergy like this is to create economics of scale, whereby if the parent and subsidiary are in the same line of business or similar businesses, what then happens in that regard is that purchasing or procurement can be centralized in one to the benefit of the other because of the large number that give you negotiation and purchasing power and bargaining skill to get a reduced or discounted price. Okay, and in that regard, that more or less creates one buying from third party or sourcing from third parties. And when it comes to selling, it sell part of it or transfer part of it to the subsidiary or subsidiary transfer to the parent before outrightly selling to the independent third parties. Okay, another scenario is issue of transfer of assets. Okay, a parent might decide to transfer his former office to his subsidiary because it's moving to a bigger office. Or a parent might decide to say, okay, I want to dispose part of my vehicle or plant, and my subsidiary is buying such vehicle or plant, or vice versa. All this also constitutes intercompany transaction that could give rise to this adjustment we are talking about. Another thing that is common is for treasury management. In treasury management, rather than you, parents, taking your excess cash to bank at 5%, and your subsidiary going to the same bank or another bank to borrow at 8%, why can't you do cash pooling, or why can't you do intercompany treasury management, where the parent can even get higher interest as much as 6% instead of 5% from the bank? We'll get 6% from the subsidiary, and subsidiary also benefit by paying 6% instead of 8% to the bank. And that also creates such intercompany transaction. Another form of transaction is management services, management fees, and some other things that more or less the affairs of the subsidiary might slightly be managed based on central or support system or shared service, where that creates management services within the group. Okay, and that also constitutes a form of intercompany transaction when it comes to shared services. Okay, another one is issue of dividend. Okay, one of the primary motive of having investment subsidiary is to enhance your returns. And enhancing your returns also comes from the residual point where the subsidiary declared dividend at the end of the day, which will be paid out as cash to the shareholders, in which the parent has majority stake. And such is what we call the cash aspect of profit that enters into an investor's pocket. In that regard, when dividend is declared and it's yet to be paid as at the reporting date, how do we more or less recognize such and account for it with respect to the adjustment that need to be made? All of these are what we consider. And all of those transactions we have made mention of would give rise to any of or combination of this adjustment. One, adjustment regarding unrealized profit on sales of inventory, okay, especially those that were done at profit, unrealized profit on transfer of assets, issue that borders on elimination of group balances or intercompany balances, or what is also known as current balances, adjustment of intercompany accrual and prepaid expenses, okay, elimination of intercompany loans, likewise interest accrued on loans, issues that borders on bill of exchanges, okay, and issues that also borders on accounting for cash and goods in transit prior to elimination of intercompany balance that fails to agree, and also elimination of dividend receivable and dividend payable, okay. And likewise, you can also look at issues that borders on issue of shares without additional payment being made or cost, which more or less speaks to bonus issues. All of these are what we are going to consider in the course of this discussion. Okay, any other question before we proceed? Any other question before we proceed? Chegmo, I think you are muted.
Oh, it's
Any question? Madam Grace, any question? Enauro, any question? Bemi, any question? Chami, Odum. Okay, if there's no question, let us proceed. Okay, we'll start our first adjustment with adjustment regarding sale of goods, which brings about unrealized profit on inventory. Now, you could read up some other things in the material, but I'll summarize everything as time goes on, okay? Now, the issue is this. Let me share my notes. Group adjustment. Now, the first one we want to look at is unrealized profits on sale of goods. Now, the question is, what is unrealized profit? Now, we'll look at scenarios. Let's look at scenario A, where parents bought 10 quantities at 10 naira, which means the old price is 100 naira. In that scenario, the parents sold 4 units at 10 naira to subsidiary. Parents sold 3 quantities at 12 naira to third parties. Therefore, parents has 3 quantities in stock at the year end. And yeah, the subsidiary sold the 4 quantity to third what? Party at 13 naira. Now, if you look at this scenario, what can we conclude there? Now, the question I'll put is, what is the group inventory as at the year end? Who can give me the answer? Who can give me the answer? What is the group inventory at the year end? I know when we talk about group inventory, we are talking about the inventory of the parent and the inventory of the subsidiary.
It's 3.
What?
3.
No, in quantity and in naira.
Oh, it's 30 naira.
Okay.
30 naira.
How do you get 30 naira? Can you explain?
30 naira because
Are you with your laptop?
hello? Can you hear me?
Are you with your laptop?
Yes.
Okay, can you do it on Excel so that you share your screen?
Excel. Okay, let me go to Excel.
Okay, when you get there, tell me so that I can allow you share your screen.
Okay. Okay, my Excel is up. Okay, my
Okay,
Excel
let
is
me
up.
stop my. Okay, share it now.
Okay, share screen. Okay, this is my Excel. So I'll just say the total, the parent quantity. Parent quantity, I think was 10 at 10 naira each. Is quantity. So which is 100 naira. Total is 100 naira. So basically, parents had sold six out of 10. Then
do it separately. Parents are sold 7.
7. Okay. Parents had sold 7. So
separated because there are different prices.
Okay, yes. Sold 4 to subsidiary, then another sold another 3 to third party. Okay. Sub, then third party. So that is it. So parents had sold 7 total. So basically we are left with I think so the parent is left with 3. So the subsidiary had 4. Bought it at 10 naira and sold the 4. I think at I think 12 naira, can't remember again. So if I'm putting price on this, I'm going to get 40. Here I'll get 48. But what is left? Subsidiary bought 4. Sold 4. So what is left here is 0. So this is what is left. So for the group, what is left for the group is this. That is this, which is for the parents, plus this, which is for the subsidiary. So which is just 3. So that is where I look at it. And
that is quantity. Can you give me the value? Because value is what goes into account.
Yeah, the value for the cost for the parent side, which is this 10. This is only, if I had that on the subsidiary, I would have put it here and put that the cost there. So for the value, it is 30 naira. Yeah, I think I'll put it here, 30 naira. Sorry. So I'll put it here. This is equals to this and this. So that's where I look at it just very briefly. So that is the value, and this is the quantity. This is the unit cost per one, and this is the total. So, but if I had that on the sub, I can just put that on the sub here, and if this is 0, and the cost is 10, and the value is obviously 0. So the total value will just be something here, maybe something here, which should definitely the total cost will now be 0. That's where I look at it. But basically, everything the total cost is 0. So that is just it. So for year,
okay, can you change the place you put group to parent? Since you have put sub separately, parent, the total will not be group.
Okay,
yeah,
okay, parent. Yes, you're right.
Parent.
Yes, you're right. This will be parent, and this will be parent.
E16 will be group.
This will be group.
Okay, can you sum the quantity of the group also 3 and 0, the same way you sum 30 and 0? Copy and paste it there.
Okay.
No, not that.
I
3
just
and 0 together, yes, sum it up.
Okay.
Can you put equals to so that I can know what you are summing? Yeah.
Equals to.
No, what I'm saying is that you put the sign so that we know what you have summed.
Sign here. Okay.
Yeah, like the way you did the one of cell F8 now, that you put the straight line.
Okay. Okay.
Okay. Do that for that 30 also. Okay. Now, that is right. Don't take away you can use that to save the worksheet. We'll use it as we move on. Okay. I'm going to stop your sharing and I'll move on to mine now. Okay. Now, what Simply has done is the same thing we are trying to do here. Okay, what we are trying to do here is to say that invariably, the parent's inventory is based on the fact that he bought 10, he sold 4 to subsidiary, he sold 3 to third party. All in all, what is left is what? 3 units. At what price? At the cost price of 10 naira. Would give us what? 300. Is it 300 or 30? Sorry.
It's 30.
Would give us 30. Now the subsidiary bought 4, sold 4. You understand? What is left is 0. At how much did he buy it for? The subsidiary bought it for what? For 10. 0 times anything is 0. That's how we got this 30. Which is right. I mean, this is scenario A. This is scenario A. Now let me copy this scenario A. And let me create scenario B. Slightly modify it. Scenario B. Scenario B, look at what I'm changing there. Parent bought 10 quantity at 10 naira, yeah. Parent sold 4 quantity at this at not 10 naira. He sold it to the subsidiary at 11 naira. And parent sold 3 quantity to others at 12 naira. Parent has 3 quantity in stock at the year end, and subsidiary sold 4 units at 13 naira. Please, will this have any effect on our group inventory at the end of the year? Can you go back to our NRO? You'll be the one assisting us all through. Go back to your slide. Let me allow you to share your slide. The only difference is that parents sold the 4 units to subsidiary not at 10 naira, which was the cost, but sold at 11 naira. Enaro, can you proceed?
Can you see my screen?
We can't see your screen. You're not sharing your screen.
Okay. Okay, I don't know if you can see it now. Can you see my screen now?
Yes, you can see your screen now.
Yes.
Okay. So parents sold the 4 to the sub for 11 naira. It doesn't make any difference because the sub actually sold the 4. So for the sub has sold the sub bought 4 actually from the parent, but it has sold all. So it doesn't make any difference to the group total.
It doesn't still make difference. Okay, thank you very much. Okay, let me now share my screen. Just keep on the track. Now, what it simply means is this. What I have here is still the same solution. Why? Because the amount in which it was sold to the subsidiary, even though above profit does not change the situation. Why? Why it failed to change the situation is because of this. Because all of the items were sold. Maybe if all the items were not sold, probably the story might have changed. But as at this point, all of the items were sold. Therefore, it makes no difference. Okay, because there's nothing on ground. Therefore, when there's no item on ground, what are you valuing? The value no longer exists and it doesn't matter. Now, if that is the case, let us now look at scenario C. Now, scenario C. Now, what is changing in scenario C? In scenario C, we go back to our 10 naira. But unfortunately, subsidiary was only able to sell 3 instead of 4. Only able to sell 3 instead of 4. And now, will this have any effect? Please go back to your slide. Let me stop sharing. It was 3. It sold at 10 naira, which was the cost to subsidiary. Cost to the parent was the same cost to the subsidiary. But out of the 4 items sold to the subsidiary was able to sell only 3. What will it have changed in this situation?
So basically, subsidiary sold 3. So if subsidiary sold 3 out of the 4, so subsidiary has 1 remaining. So subsidiary has 1 remaining. So basically, this one, there's a difference. So it's going to have a bearing. So parent has 3, subsidiary has 1, and the cost is the same thing. That is, so basically it's going to have a bearing 4 and 14 naira. That is the quantity for the cost of the 4 is 14 naira. That's just it.
Okay. Now let us now look at it from, save it there. Let us look at it from this aspect also. Now, let me copy what we have. Now here, it didn't sell 4. What is sold was 3. Which means it has stock. It has stock of 1. And that 1 is valued at how much it costs the subsidiary. It costs the subsidiary 10, would give us 1 times 10.
It's 10.
1 times 10 is 10. 10 plus 30 is what? 40. Okay, which means there is no problem. Now let's look at scenario. Let's look at scenario D. Scenario D. What is changing in D is that it sold 3 units, but we didn't buy at 10 naira. We bought not at 10 naira, we bought at 11 naira, which is 1 naira above what the parent bought it. Therefore, can you tell me that what will have been the group position? Share your screen now.
Okay. So subsidiary bought it from the sold. Okay. So the group position, from what I think, is that the costs for the subsidiary will now be 11. The cost will now be 11. And so the total unit left will be 4, and the cost, but this cost to the, I think the cost to the group will not be correct, but this is the cost. I think
You know it's not correct.
Pardon?
How do you know it's not correct?
But no, for parents, it's going to be 30 naira worth of inventory left. For the sub is 11 naira worth of inventory left. But for the group, 4. The group as a whole, I don't think 40 naira is there. So this is the element of unrealized profit, this 1 naira. That's what I think.
Therefore, we already have a problem there. Yeah. Now, take note of that. Let me go back to my script. Okay, now from what you've done, what we are saying is this. Is this that, okay, I've not changed it to scenario D, okay? Okay, let me change it here. The name is D, okay? Okay. This scenario D. Now, this is 11 naira. 3 units was sold, remaining 1, which give us 11. This gives us 41. But the question is this 41 correct? Now, let us assume that this 4 was not sold to subsidiary, but was sold to third what? Party. What will have been is that here, it will have been that parent, let's assume subsidiary is not buying anything from parent. That means parent inventory will be 10 minus 3 that is sold to third party minus initially it's supposed to sell 4 to subsidiary and subsidiary sell 3 to third party. Therefore, let us assume that since subsidiary is not efficient enough to sell all of the 4, let us sell out of this 4, we'll sell 3 to third parties. Which means if out of the 4, the parent reserve 4 for other third party on behalf of subsidiary and decide to sell it directly to those third party on behalf of subsidiary, we'll have sold 3 out of the 4, leaving 1, which means 10 minus 3 and 1. Okay, not 1 now. This is 3 plus 4. Okay, let me clean it so that you understand what I was trying to do. What I'm saying is that the parent decide to sell out of the 10. Parent bought 10. The parent sold 3 directly to the third party. It reduces the 10. Now, parents sold another 3 indirectly through subsidiary to third what? Party, which is 3. Okay, which means this 3, instead of us giving the subsidiary 4, yeah, we'll give the subsidiary 3 because it's 3, he has the ability to sell to third party. Whereas we don't want inventory to be in the hand of the subsidiary, which means subsidiary just acts as an agent. When you have anybody that want to buy from you, bring them to us. At the end of the day, they brought 3 to us. We sold 3 directly. What is left is what? 4. And this 4 is valued at how much to the parent? 10 naira per 1. Where is that 10 naira? This 10 naira. Now, doing so, the value is how much? 40 naira. Because this 10 and this 4 multiply each other, give us 40 naira. But what do we have here? We have 41. The question is the difference between 40 and 41 is 1 naira. Where is the 1 naira coming from? The 1 naira comes from the fact that we need to recognize that there's unrealized profits. How do you know? Remember, it cost the parent 10 naira, but it's sold to the subsidiary at what? 11 naira. Therefore, the parent added or loaded 1 naira profit on every unit sold by it to the subsidiary. In that regard, that 1 naira times any unit the subsidiary is unable to sell during that period will be considered unrealized from the group perspective, which means the 1 unit outstanding times the profit of 1 naira loaded will amount to this adjustment we need to make. will lead to an adjustment of 1 naira that we need to make. It's upon making that adjustment that we can come to the true value. This is the true value of group inventory. And what is the value? 40, which means this 40 equals this 40. And that is what I believe Enaro was trying to explain. Is that correct, Enaro?
Yes.
Any question? Now, what is our conclusion?
Okay.
Therefore, what is our conclusion? What can we draw as an inference from here?
What you said is that we should deduct the unrealized profit from
Our conclusions include one. When goods are sold within the group at cost, regardless of the goods partly or completely sold or otherwise, there won't, or let me use this language, it won't give rise to unrealized profits. 2, which is what scenario A and B prove to us. I'll just say C scenario A and B. C scenarios A and what? And B. That's what that proves to us. B, or 2, where intercompany sales are made at a profit, but all of it had been sold outside the group. It will also not give rise to what? Unrealized profits. Again, C again, C scenario C. Now, the last scenario, which I can put in, let me put it in this color, where there are intercompany sales of goods at profit, and a part or the whole remain unsold. At the reporting date. This does, okay, it gives rise to unrealized profit. See scenario D. Does that make sense to us or not? Does that make sense to us? I want to answer.
Yes.
Yes.
Okay. If that is the case, then what is unrealized profit adjustment? Then unrealized profit adjustment is derived as thus. A, unrealized profit is equal to the percentage of unsold goods multiplied by the amount of profits on sales made. Okay. Alternatively, if you don't have the percentage or you can't get the percentage of unsold goods directly or indirectly, you can make use of the value of unsold goods multiplied by the margin. Or you don't have the margin, you have the markup, or otherwise you use the cost of unsold goods times the markup. What it means is that if you are giving value of unsold goods, you multiply with margin. If you are giving cost of unsold goods, you multiply with what? Markup. But this first one addresses it all easily than the other two, but you get the same results. But the challenge here is that you might be given value and you are given markup. What you do in that regard is to convert markup to margin. Or you are given cost and you are given margin. What you do is to convert margin to what? To markup, which I'll just give you a clue here. Recall that one, a markup is an expression of profits as a ratio of cost. Okay, which I can call P over C. If P stands for profit, C stands for cost. Whereas margin is expressed as profits over selling price. And selling price is the same thing. How do you determine selling price? First, you know your cost and you know the profit you want to add to it, which means I can say this is P over C plus what? P. And note something here. Note something here. That relationship exists between selling price and cost, because cost plus profit is selling price. Therefore, if you have markup and you have cost, like in this case, cost and markup, you are good to go. But what if you have value and you have markup? It then means you have to convert markup to margin. How do I convert markup to margin? Markup to margin is for me to look at this expression. Now, if markup is P over C, therefore I can say, I can convert it by saying P over C first, which is markup, and look for the P and add it to the denominator, which makes us to know that P over SP is our margin. And likewise, if you are given value and you are given margin, you are okay. But sometimes you are given cost and margin. What then do? You convert margin to markup. And which says markup is the same thing as saying the margin, P over SP. Let's try and subtract this profit from SP. And remember, if you take away profit out of selling price, what is left is what? Cost. And that's what we've done. That is the manner to which you convert. But conversion is only required when you are not given two like terms. Two like terms are value of an item times the margin, or cost of an item times the markup, because both are expression of profit. Otherwise, you make use of the percentage of unsold goods times the profit on sales. The percentage of unsold goods can be done relatively based on the unit, or based on the cost, or based on the value. Your answer will remain what? The same. Any question before we forge ahead?
Hello, sir.
Yes, sir.
So I don't have a question per se. I am still just struggling with the scenario 3 where unrealized profit is recognized. So
No, scenario 4, not scenario 3.
Okay.
That is it. I check.
Yeah. 4.
Yeah.
No. In our conclusion, I'm still struggling to absorb this third part.
What we are saying is that when we look at all of the 4 possible scenarios, the only scenario that gives us problem, which we now have to identify and trace to unrealized profit, is scenario 4. And where is the problem is that anytime the parent sell above what it costs the parent to the subsidiary, and the subsidiary is unable to sell all of those items, it will always give rise to unrealized profit. That's why I didn't just define it, I used scenario one by one. And the scenario is what gave us a revelation of where the problem lies. You only have unrealized profit as an adjustment within the group whenever there is an intercompany sale of goods among the parent and subsidiary, such that one party sold to another at a profit, and the other party was unable to sell all of those goods before the year end. It creates unrealized profit, because the profit one party thought he has made is sitting in the value of inventory of another who is a member of the same group. Does that make sense?
It makes a, thank you very much. I get that.
Yeah, that's it. Okay, now on that premise, let us now look at a scenario to address that. You can read the scenario further. I did a similar scenario in the text, but different approach, but what matters is your level of understanding. Okay, let me cut this question out. Okay, let me share my whiteboard. Following, I want you to read this. I will move on. Can you see it?
Yes, sir. Okay, illustration 1.
Not illustration, start from further classify.
Okay, we could further classify the transaction between the parent and the subsidiary as either of a downstream, that is down the stream, or upstream, that is up the stream transactions. Downstream transactions are those transactions emanating from the parent to the subsidiary, that is down the stream, okay? E.g., goods worth 10 million transferred or sold to the subsidiary. Upstream transactions, on the other hand, are those transactions emanating from the parent, from the subsidiary to the parent. That is, goods worth 10 million transferred or sold to the parent. Downstream transactions now. This involves the sales of goods by the investor, that is parent, to the investee, that is subsidiary. Since the profit is recognized by the parent upon sale of the subsidiary, the unrealized profit should be adjusted against the consolidated retained earnings as shown below. Downstream transactions, and when downstream transaction exists, you are supposed to debit the consolidated retained earnings and credit group inventory with the total unrealized profit. Can we go to the illustration now?
Yes.
Okay, so illustration 1. Pali PLC acquired 160 million of the shares of Suzy PLC, where the reserves were 20 million. During the year of 31st December 2015, Pali sold goods costing 10 million at a profit of 20% of the cost to Suzy PLC. As at the reporting date, only 40% of the goods were sold to external customer by Suzy. In the same period, the statement of financial position of the dual company as at 31st December 2015 is as follows. Okay, statement of financial position for Pali and Suzy. All figures correct? Yeah, that's also.
Read them out with the figures.
Okay, so we have assets for Pali and Suzy from non-current asset now. PPE is 110 for Pali, while Suzy has 120. Investment in Suzy by Pali is 100 million. Current assets, that is inventories, for Pali at the close of the year is 40. For Suzy at the close of the year is 45. Account receivables, 15 for Pali, 12 for Suzy. Bank balance, 5 for Pali and 7 for Suzy. Equities and liabilities now, that's total asset. Total asset is 270 for Pali and 184 for Suzy. Equities and liabilities now. Equity ordinary shares at 50 kobo per share. For Pali, it is 80 million. For Suzy, it is 100 million. Retained earnings. Pali has 140 million retained earnings, while Suzy has 60. Current liabilities. Pali 50, Suzy 24. Total equity and liabilities. 270 million for Pali and 184 million for Suzy.
Okay. Now let's try and sub this together. The first thing that comes to our mind is the structure. Pali acquired 160, but out of how many shares, we don't know, but we know that the share capital is 100. I'll know this is 50 kobo, Abi. It then means the number of shares of SUSI is 100 million naira divided by 50 kobo per share. And that should give us 200 million shares.
200 million shares.
Therefore, the percentage here, you can say, is 160 million out of 200 million shares. That should approximate 80%. Now, if that is the case, what is the group structure like? Pali and what? SUSI. Pali is what? 80%. NCI is what? 20%. When is the date of acquisition? We don't know.
December?
No, it's not 2015. It's sometimes ago, but what matters is that we know the reserve as at then. Let me put it sometime ago. But we are reporting when? Many years what? After, which is 31st December 2015.
Oh, yeah.
Okay, what matters to us is that we have sufficient information to split SUSI's reserve as at today's date into component that is pre, and component that is what? Post. What is the reserve? The reserve is 60. And as at acquisition, it was 20. Therefore, we'll come here, we'll say 60. And as at acquisition, it's what? 20. Therefore, what is our balancing figure?
40.
Our balancing figure is what? 40. Is that not?
Yes.
Okay. Now, what matters now is there was intercompany sales. Sales of goods. Who sold to who? Who sold to who? During the year, Pali, the parents, sold goods to who? SUSI. Which means the parents sold to the subsidiary. And we categorize this as what? Downstream. Now, why is it downstream? We are going to learn it today. Downstream transactions. Okay. Now, the first thing we ask ourselves is, what is the profit made on sales? The profit made on sales is a function of whether it's a markup or margin. Now, look at this information here. During the year, let me highlight it. During the year to this date, Pali sold goods costing 10 million. The word costing is to be emphasized, which means they are not giving us the value of the goods. They gave us how much it cost the parent to buy from its vendor. And in that regard, it sold at a profit. That's another emphasis. Of what? 20%, another emphasis. On what? On cost. That's another emphasis. which means we have 4 things to emphasize here. The cost to the parent, that the parent was not charitable enough, is sold by adding something to the subsidiary. And what he added is 20% on the cost. Therefore, what do we do? In this case, we are blessed with this information. We are blessed with the markup, and we are blessed with the what? With the cost. Otherwise, in some instances, you'll be blessed with markup, but you'll be given the value or the what. And they don't go hand in hand. If you recall what we discussed here, value goes with margin. Cost goes with what? Markup. Now, if that is the case, I just solve it directly. The markup is 20%. The cost is 10 million naira. Which means the profit made by the parent is 2 million naira. Which means the selling price to the parent is the 10 million it costed plus 2 million naira profit he added. Which means it's sold to the subsidiary at 12 million naira. Now, the question we now ask is that of these 2 million naira profits, is it all realized? It's a simple question. Is it all what? Realized. Who can answer that question?
I can try.
Yes.
I think it is not all realized because the
Why,
person wants to know that the subsidiary did not sell everything. I can't remember.
Now, yeah, look at the emphasis. He said, as at the reporting date, only 40% of these goods were sold to who?
External.
Were sold to external customers by Susie. Now, which means the portion realized, we have to split this into 2. Portion realized and portion what? Unrealized.
Yeah.
Portion realized is attributed to the portion sold to third parties. Portion unrealized relates to portion what? Unsold by the subsidiary. Now, what portion was sold? What portion remained unsold? 40% of these goods were what? Sold. If 40% were sold, I come here, this is 40%. And this is what? 60%. Now, what problem do I have? I have no problem. I have no problem with realized. But I have problem with what? Unrealized. Why? Because unrealized means in the profit of the seller, which is the parent, is carrying profit that has not been truly realized. Therefore, what do? I go ahead with the portion where I have problem, and I do what? That portion I cut it off. That portion of problem is the portion attributable to what? Unrealized what? Profits on sales of what? Goods. And what is that? Unrealized profit is now the percentage of unsold goods, which I showed you earlier. What percentage is it? 60%. Multiplied by what? The profit made on sales, which is what? 2 million. How much is that? 1.2 million. Which means of this 2 million, 1.2 million is unrealized. Now, unrealized in whose book? That is where this is relevant. In the books of the seller. Who is the seller?
Parents.
Parent.
Which means we'll go to the profit of the parent. Remember, retained earnings of the parent is reading 140. In this 140, there is 1.2 million that's unrealized. And what do we do in that regard? We remove it. The process of removing it is this entry that was given to us that go to the parent's book and remove, by way of debit, the unrealized profit. And that's what we want to do now. We'll come here and say debit, parent, which is the seller in this case, profits, which you can see from the consolidated retained earnings. And go to the subsidiary's book. The subsidiary is the one carrying the inventory because he's the buyer. And remove what? 1.2 million. But again, we know that the subsidiary inventory will still be consolidated with the group. That's why we said, go to the group inventory and remove that same what? Amount, 1.2. If we have done that, we can easily now come to determine our goodwill, if any. Okay. Cost of business combination, Pali's investment in Suzy, NCI measured 20%. What is this investment? The investment is 100. Fair value of Suzy's identifiable net worth asset as at the date of what? Acquisition. Share capital and pre-acquisition reserves. Share capital is 100. Pre-acquisition reserve is 20. %20 of 120 will give us 24. This 124, which means our goodwill is 4. Consolidated reserve and NCI as at 31st December 2015. Pali's reserve. What is Pali's reserve? 140. Value of NCI as at acquisition date, that's 24. Share of post-acquisition profits, ratio 80:20 of 40. That is 24. How much is that? 40. That's 32 and 8, if that is correct. Now we'll go back to adjustments. Adjustment for unrealized profits. We said we should charge the parent alone, 1.2. Unrealized profits on inventory, 1.2. All things being equal, what do we have? 32 here, and 140 plus 32 minus 1.2. That's 170.8. Now the balance sheet. The balance sheet. Consolidated statement of financial position as at 31st December 2015. All figures in millions. Assets, non-current assets, property, plant, and equipment. What do we have? 110 and 120. That's 230. Goodwill. For current assets, inventories, $40 and $45. That's 85. Trade receivables, $15 and $12. That's 27. Bank, 5 and 7. That is 12. What do you have? 85 plus 27 plus 12 gives 124. Not a plus 234, give what? 358, which presumably is our total what? Assets. Asset is financed with equity and liabilities. Equity is made up of share capital and reserves. Share capital, Wally, that is 80. Consolidated retained earnings, $170.8. That's 250.8. This is equity attributable to Pali. Non-controlling interest is 32. That's 282.8, which is our total equity. Current liabilities, let's say we have payables. $50 and $24. $50 and $24. I think I got it right. 50 and 24. That's 74. All things being what? Equal. $282.8 or 74 give me 356.8. Now, who can tell me where the problem lies? Who can tell me where the problem lies?
Yeah, we earlier debited the parents' retained earnings for.
Yes, which is this?
Yeah, but we are. Yeah, we are yet to reduce it from the inventory. Yes.
Yeah, the second leg is you reduce the overstatement in the inventory of subsidiary, which means you come here to say this inventory of the subsidiary that was 45 is overstated by how much? By 1.2. So that when you add everything together, this is no longer 85, which will affect this balance, which will affect this balance. It is what? It is 83.8. 83.8 is not showing clearly. 83.8 plus 27 plus 12 will give me 122.8 plus 234. It will give me 356.8. Now, the reason why I'm doing all this is for you not just to be following. Let us try to identify where problems are, which means you can easily trace a problem as you try to solve another problem. Any question on this? Any question on this? Okay, I'll give us 5 minutes to meditate on it.